But there's two ways you can do it. You can expense it, or you can capitalize it and make it an asset on your balance sheet. And now let's get into that. That's the big thing about, we've been talking about, all this kind of stuff. Now there's the next, I'm going to erase this, okay? The next big subject to talk about, now that we kind of know income statement and balance sheet, right? I'm just going to give you a little quick. A balance sheet is just a picture in time, right? It's just a snapshot. It's what the house is worth now or what all your assets are worth, right? So you usually have one of those at the end of the year, let's say, right? And so say this might be for, the end of 2017. Now during 2018, last year, right, you would have an income statement, right? And that income statement would be all the revenues, this would be the assets, liability, and equity, all the revenues, and then all the expenses and the profit that was made, right? And then we're going to have a balance sheet at the end of this year, right, 2018. And so this is what happens during the year, and these are the two bookended things of those years, right? So, and what we just talked about was that the net income can be dividended out, or it can go in as retained earnings. And by retained earnings, it means it would be added to this. If you made, $100 in profit, then it would be the equity from here plus 100, right? Make sense? That's how these things are kind of connected. Now there's another one down here called the cash flow statement that we'll talk about that basically does some adjustments. But for now, this is just so you can start to see the flow of these things. And that's how you increase your equity, and that gets offset basically by an increase in your bank account, in your cash position, and that's what the end of the cash flow statement gives you, the cash, and that goes there, and then these things once again will balance out, right? And so the cash flow statement starts with net income, and then makes some adjustments, so we'll talk about that. But just conceptually, as you start to see this, right? So this is the one that goes through time, and these guys are just like snapshots. And they change based on what happens during the year, right? If you lose money in that year, it's going to be equity minus whatever that is, right? That'll be the math of it, right? And then the cash will balance out. It's going to change this side by $100 plus, right? And then this side has to change by $100 too. And it's primarily the cash account that at the end of the cash flow statement, when it does the reconciliations from net income to actual cash, that goes into that. Then this number has to equal exactly what's in your bank account, and that's where the reconciliation means here's the bank account, it says 15 grand. This number has to be whatever this number is, cash, plus this number has to be 15 grand to the penny. And that's where accountants go nuts, because inside of a company, because it's a lot of times there's a little mistake somewhere, and you got to go back and find it until they actually balance. Just to give you that kind of an idea about where we're headed, right? And we'll talk about the cash flow statement. But first we got to talk about why we need a cash flow statement.